Hey, what's up? My name is Rhett, and I'm in Chase Johnson Studios here for Cut to the Chase. And it's a special opportunity for Financial Hour. And some of my background, I've spent over a decade in financial planning. So, looking at anything from investment planning to tax planning. But really, why is this important right now? It's March of 2025. So, getting some questions from friends and family about what is the best way to lower my overall tax payment bill? What can I do? Well, there's a couple options. There's three options that I'm thinking of for you right now, and a couple that you can immediately take advantage of. The first one, first and foremost, you may have heard of this. It's just a bunch of letters. IRA, traditional. Traditional IRA, sometimes referred to as contributory. All that means is if you make 50 grand a year or whatever amount of money you make per year, you can say, I'll take $7,000 of money right now, even if it's money from a savings account. But if you take that money and put it into an IRA, what happens? Well, the IRS will see that you are only supposed to pay $43,000 on a taxable income there. So that $7,000 literally lowers how much you'll have to pay. So if you're in a 25% bracket, maybe your filing is just an individual, you don't have any other dependents, no kids, no wife, no husband, nothing like that. It's just you. You can put 7,000 into a traditional IRA, and that will save you a couple $1,000 if you put in that full 7,000. That's an immediate benefit. That's literally cash money in your pocket right now. Great way to save a little bit of money. It's also super helpful if later on down the road, what do the consequences look like? Well, that money grows tax deferred. So you buy a stock inside that account, it will grow tax free. And then later on, when you're 59 and a half, you just pull out that money, you pay taxes on whatever it's going to be at that point in time. No big deal. If you think you're going to be in the same tax bracket or less later on, that's a great plan for you. Well, let's take the same idea and put it through the IRA Roth. So people think, well, Roth, oh, well, it sounds great. There are some pluses and some negatives. The plus is when you put money in your Roth, you can take that $7,000, put it in, and you don't have to necessarily pay taxes on it since it's money that's already money that you saved, but you can't, it doesn't lower your overall taxable income. So you can't deduct it on your taxes. That's kind of the catch there. So you're not going to save a few $1,000s on it. Instead, you're technically paying taxes on it because you've already paid taxes on it. Maybe you work for a company, they've already withheld taxes, whatever that looks like for you. Now it grows tax free. Not just tax deferred, but tax free, because when you withdraw it at age 59 and a half or greater, you don't pay any taxes on that initial amount or any of its babies that it created. So if your 7K turned into 20K or 30K, you're 60 years old, you pull out that full 30K in 1 year, no big deal. No taxes are going to be owed. So, a nice way to do it is to round it out with a 401k as well. So, there's your three ways. 401k is the same thing as a traditional IRA in the way that it allows you to defer taxes. It'll lower your taxable income. The only catch is you can only do those 401k contributions in the year that you were working. So, by the time you're thinking about filing your taxes, a little too late to take care of the 401k, but you can do it all through the previous year. So if you're watching this video and you're thinking, well, how can I lower my taxes? Right now, my work offers me a 401k. Maybe they match you. A lot of companies will. If you stay with them long enough, they'll give you a vesting schedule, VESTING. So you can look up a vesting schedule. They will tell you, they'll be like, hey, if you're with us for 3 years, all of those matching contributions will be yours. So a lot of times they'll give you that 3%, and each year you put that money in, they will match a certain amount. And then if you're with them long enough, those are yours. You get to keep those, even if you separate from the company after that. So I always say match your 401k contributions first and foremost. If you have more money that you like to put away and get a tax deduction on, go ahead and slide it away into a traditional IRA. You have up to 7,000 that you can put in there. No issues, no problems, and it deducts your overall tax liability amount that that you have to pay for. Someone's got to pay for it. You can either give them their money now or give them that money later, whatever you want to do. Now, if you go ahead and do both, you could do 401k money, match that, get all your contributions, and then maybe put a little in your Roth. Because who knows? Later on, you can do a little bit of both. You can withdraw money. Maybe you're getting Social Security income. So take money from Social Security, take money out of your traditional 401k, your traditional IRA, and then it gets you up to an income that's high enough taxable wise where maybe you might be hitting this threshold of another tax bracket, and it's at that point that you would then withdraw money out of a Roth 401 or a Roth IRA, whatever it is that you have. Traditionally, it's going to be a Roth or a traditional or contributory. Those are what they're typically called. So one of those two is going to be what will likely work for you. Those are some really simple ways that you can effectively manage your taxes right now after your tax year. Throw it into that traditional, or if you're feeling real good and you maybe think you're in a higher tax bracket later, put a little bit of money aside into your Roth. Remember, you can always take that Roth money out early if you need. You can take out contributions tax free. You have to leave the babies in. Whatever it's profited, whatever it's made, you can't take that out. You can, you just have to pay taxes and the 10% penalty for taking it out early. Same thing exists on your traditional IRA. So if you pull money out of that, you can still take it out next year, but you're just going to have to pay taxes in the year that you take it out and also your 10% penalty. So that's what the IRS says. That's the law for now. Same thing exists for 401k, but typically when you're still with a company, you would either have to take like a hardship withdrawal in order to get that money out. It's a little more difficult, or you can take a loan against your 401k. Sometimes they'll let you do that. So you can take a loan against your own money, pay it back, and you won't have to worry about actually paying any taxes or any penalties even. So it can be a nice way to get some of these tax benefits and still help you save if something terrible happens later on. You can always take money out and use it then. So those are just a few simple ways that you can save yourself on taxes for the year 2025 or whatever year you're watching this video. So take care of yourself, take care of your pocketbook, keep saving and keep putting money away. It's been a pleasure. And if you have other questions, please let me know. My name is Rhett.